Good afternoon, everyone. Welcome to this TradeStation webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. It's always a pleasure to be doing these webinars, especially on a special topic like this, which is options replay. This series is very practical, so you'll see real examples of trades that could have been placed on the market and the reasons why a trade could have been placed into the markets and the reasons why it worked and it didn't work. So the title of today's presentation is Options Replay. We do these sessions every 2 weeks. So make sure that you check our events calendar if you'd like to register for these again. So we are trying to strategize your options trades. Our guest speaker today is Brandon Wendell. We'll pass the microphone over to him in just a moment. But thank you for taking the time out of your schedules to be here and learn a little bit more about options. This one in particular, David, is going to be on equity options, not on futures options. We do have a futures options replay that we do every so often. It's not every other week like we do equity options. So make sure that you check our events calendar if you're looking for a futures options replay. So this is equities options. Keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Also, active trading is not suitable for everyone. We have all the risk disclosures right here on this PowerPoint slide. And also, let me point out that Brandon Wendell, even though it's a pleasure to have him and he is willing to share all his expertise with all of us, he's not affiliated with TradeStation. He's a guest speaker, so his ideas and methodologies are his own. If you need additional information on these disclosures, please visit www.tradestation.com/important-information. All right. So Brandon Wendell is an expert trader and educator. He's been involved in the markets for years. So I won't steal his thunder when he makes his introduction. I'm just going to stop my share and mute my microphone. And Brandon, I'm just going to extend a warm welcome to you. Thank you for being here. The floor is all yours.
All right. Well, thank you very much for having me. I appreciate it. And I'll go ahead and get everything set up here. Just got the chat open now. So there we go. So we can go ahead and go over a few things. Obviously, the markets are a little bit excited recently. Yeah, I'm not going to do too much by the way of introduction because many of you probably know who I am from previous sessions, but I've been in the equities. I'm sorry, not in the equity. I'm just in the markets in general, futures, Forex, trading everything, options since 1996. So it's been quite a while. And I got in the education realm back in 1999. And like I said, it's actually a heck of a lot of fun for me. I kind of balance my trading life and my education life where I'm able to help people by reinforcing the rules that I personally use in my own trading. So gained a little bit higher knowledge by gaining a CMT designation, which if you're not familiar, that's Charter Market Technician, basically kind of a master's degree in technical analysis. And yeah, like I said, I kind of use that information to help my students and people like yourself, fellow traders, basically, to get better in the markets and try to perfect what they're trying to do. I don't know if we can ever perfect trading. We just get better and better at it. There's always improvement available, right? Basically, what I'm going to do, let's see if I should have my OptionStation Pro open. Yes, I do. A while back, we went over quite a few different positions. One of them, which we're going to dive back into, is on Newmont. Did a couple of vertical spreads, and they have given back some of those profits as of late because they were actually both bullish spreads. And one of the sessions we did previously, we talked about how to decide between whether we should do debit or credit spreads. And you can see I only have 9 days left till expiration on these options. What I have here, yeah, perfect. So now you can see this better. I could zoom in. Anyway, you can see I did two vertical spreads. I did a bull call spread, which is a debit spread, and then I did a bull put spread, which is a credit spread. For the debit spreads, basically what you're doing is you are paying to get in the position. And let's see here, I'll increase or expand these as well. So as you can see, I have both long and short. Yeah, wrong one. There it is. For the vertical spread, we have the call side where I basically bought a slightly at the money or in the money call, and then I sold an out of the money call to reduce the cost. So you see, I did a long and a short. And basically, the reason why I did that is because it gives me a discounted price on the call that I was looking to buy. A lot of people who want to trade options do single leg options. Talked about this before. And one of the advantages or disadvantages, really, of single leg options, for instance, if I go back to Newmont, just as an example, and not necessarily well, we can look at the ones that are expiring soon. And if I go back to 40 and we look at that call, if I select that call, it doesn't have everything I needed on the Greeks there, so I'll put it in. And there we go. Theta, Vega. Not going to worry about open interest for now. But right there, now I've got the Vega, Theta, Delta, some of the Greeks that are things I want to pay attention to. And obviously, in the money option right now, this has a positive delta of 0.83. It's above 50 at the money options. Typically have a delta right around 50, as you can see here. That's the line kind of separating in the money and out of the money. So we have a higher delta because we're in the money. But at the time, actually, I think I have a picture of the orders. Went ahead and did all this ahead of time. There we go. Entered on 1/7. So on, I'm sorry, 1/27, January 27th, I got into both of these positions near the end of the day, the same time, basically, for the most part. And it was filled right away. So I did the vertical spread, and let's see if it shows which is which here. Oh yeah, right there. Those puts, those are the calls. So it looks like I did the calls first and then the puts. So at the time, if we go back, I think, let's see, where's the chart here? And here we go with Newmont. And what I'm going to do is insert a study, and the study I'm going to add is implied volatility for all options. And the reason why is part of the decision-making process for me is not the first step, but the second step. First step is I try to figure out if I'm bullish, bearish, or neutral on the underlying security. There it goes. I just had to go to daily. Where do you find the definitions of things like delta and vega? I believe we have some of that online. I think the TradeStation has TradeStation Education that should have some of that covered. And for the most part, I mean, it's relatively simple. I can go over that pretty quick with you because delta is direction. Think of D direction. That tells you how much profit or loss the option might, that's how much the premium of the option should change for a 1 point move in the underlying security. So in this case, if you have a delta of 0.55, if Newmont, the stock, moves up by $1, the option premium should gain 55 cents if it has a positive delta. A negative delta moves in the opposite direction. So right here, where you have a negative delta on the put, if Newmont goes up by $1, this put should drop in value by 49 cents. That's what the delta is. It's direction, D for direction. Then you have an easy one, T, time. That's theta. Theta tells you how much the option should decay in value every single day. And it's basically at the end of the day, when settlement occurs for a lot of the indexes, you'll have the options also be settled that expire that day, and the time value gets deducted. So you'll see that happen at the end of the day, going into the next day, and that's time value, theta. Vega, is for volatility. And volatility changes impact the pricing. So again, if you have positive numbers, they move with. If you have negative numbers, it moves against when you're buying. If you sell options, those operators reverse. Positives become negatives. So in the case of theta, you see we have a negative theta right now. That means every day that goes by, the value drops by that much, 10 cents. By the way, these are shown per share for that premium. Okay. And remember, when we're dealing with stocks, we have to multiply by 100 for all those. So it's $228, and it'd be the delta of 55. Again, you're going to be losing $5.50 each day. I think it was right. And then Vega, volatility. Well, volatility has been going crazy recently. So for instance, if I go to analyze here, just on that one option, take off these others, the verticals I had there, delete. Come on. There we go. So with a single option, there we are, that 40 call, you can see that the current price, it looks like it was about $5.50 for the premium. And we can use these price slices to tell us what's going to happen with price if it moves up or down, or if other things change, like volatility. So for instance, the last price right here, we were at 44.86. You can see the value is 549.97, and we're basically buying it for $550. Remember, you got to multiply by 100. So we're pretty much buying it at value, right? Therefore, we would not be paying over, and we wouldn't have a profit or a loss right now, basically is what it comes down to. However, if volatility were to increase, not price movement, let's just say volatility goes up by 3%. Now what happens? The value actually went up by $5.76. And that's because we have a positive vega, right? I don't know if it shows down here. It shows what the current volatility is. But again, if I want to see what the vega was, I just go back over to the option chain. And you can see the vega was 0.03. So basically, it's $3 for every 1% that prices move. Or sorry, not prices, volatility moves. And if volatility dropped, then it would be a negative. So that's kind of the quick and easy on the options. Greeks, again, if I did -3, there we go, -3, notice we lost $5. Okay, so that is a calculation to show us how much volatility will impact our price. And that's a big thing. A lot of people ignore volatility, but when you look at volatility, again, I go back to that chart, and here's our implied volatility. Look what just happened. In the past couple of days, we went from 37 to 53 for volatility just on that particular stock, on Newmont. That's a big move, and it's not unusual to get pretty good size swings. They usually don't happen in a day and a half, but then again, tariffs don't happen in a day and a half usually either. So we have this big change, again, going back April 4th or 3rd. Yeah, there was 3rd was Thursday, and volatility was at 38%, and Friday it jumped to 53%. So we had a 15% gain in volatility. So what does that do to our option? Again, if you have positive vega, even if prices don't move, look at that. We had a $30 gain on a $550 position. That's a pretty big price movement, right? Percentage-wise, especially. So we got to make sure that not only are we choosing the right direction for our security, the underlying security. I mentioned this before a couple of times, and I'll say it again. I try to keep options trading relatively simple. Simple doesn't mean easy, okay? Simple means there's very few steps to it. And step one, are you bullish, bearish, or neutral? Oops, on the underlying. And bear with me for a moment, take off the snap mode, and I want to edit this. Come on. I thought I could just right-click on, or click on it. There we go. No, there we go. Edit text. Whew. Took me a while to get the right mouse stroke. There we go. Now we can actually read it. So number one, are we bullish, bearish, or neutral on the underlying security? That's number one. Then number two, are options cheap or expensive? Well, that's basically looking more at the volatility. If options are relatively inexpensive, it's because volatility is usually a little depressed. It's down. If options are expensive, volatility is usually high, and it causes that. Again, there are other factors, but trying to simplify things as much as possible. Typically, when you have high volatility, options are overpriced. When you have low volatility, options are typically undervalued. And then number three, I select the correct strategy. So when we go back to January 27th, here we are, bring in a vertical line there to market. You can see that for the most part, we were pretty much dead even on the average for volatility, right? Because the blue line here, that is the implied volatility, and the red line is the average, a moving average of that implied volatility. Well, looking back, we were a little bit high in comparison to where we've been in the past, but obviously a little high got higher and also went lower. So there's a couple different ways of profiting when it comes to options. Obviously, one of them is direction, which is most of what people do. They buy calls or they sell puts if things are going up, and they buy puts or sell calls if prices are looking like they're going down. But we can also take another dimension with options, and we could trade time and or volatility. And that's one of the things that, again, if we were at average or even below average, we could possibly buy cheaper options expecting them to go up in value. And we can kind of test this theory today because we know that volatility is extremely high, and it may not be the same on every security. However, we can actually bring in another value here, theoretical value. Let's see, where is it here? Actually, I wonder if they have a skew, IV skew, what that shows there. But right here, theoretical value, that's what I want to show. If you're not sure what something is, that's the other neat thing is you can actually go into the help right here and look it up, and it'll give you definitions of all these things as well. And I'm going to get rid of the IV skew for right now. We don't really need that. But basically with the theoretical value, I believe it's based on the Black-Scholes method. You might be able to change it. There's a couple different ways. Bergstrom, I think, is the other. There's a couple different calculations for getting theoretical value of options. But right now we look at the money option here, the calls. We see that the theoretical value is Only $1.23. And what are we trading at? 215 by 228. So what does that mean? Options are overpriced, aren't they? Everybody's asking a lot more than what they're theoretically valued at. Why? You just saw the implied volatility was skyrocketing. Same thing on the put side. The actual value, theoretical value of these puts right now is only 82 cents. Meanwhile, they're asking you to pay 205 to buy it. That's overvalued. So what do you think we want to do when things are overvalued? You don't buy them, right? You sell them. So that's why looking at the opportunities that are there, again, we go back to where I was, the implied volatility was basically at average, and we could either buy calls or sell puts, debit or credit for the types of spreads. And you can see right now the debit spread is making a little bit more money than the credit spread was. Why? Well, implied volatility went up. So when you buy options, what happens if implied volatility rises? Again, we could take a look at this one in particular, going back to the analysis, get rid of this and bring in the calls. There we are. Now we're analyzing those calls. And based on that, here's our current price, and the blue is the at expiration. So last price right now, you can see that we have a value of about $513.98 right now based on where we are with volatility, with everything happening. Oh, sorry, that's not right. That's better. No, it's still showing the 513.98. There we go. So we have roughly a $200 profit according to this. If we go to manage and see what we actually have, 201. So it's right there. So we're pretty close to the theoretical value based on everything going on with price and the implied volatility rising. How much of that is our intrinsic value? Not a lot, is it? Because intrinsic value, if you're not familiar, is simply how much the option is in the money. Well, we have a 40 strike and we're trading right now at 44.86. So you have $4.86 of intrinsic value. However, we lost a lot of value from time decay. And that's why typically when I buy options, you don't want to buy options that have very little time left until expiration. These options only have 9 days left until expiration. And what's happening, even though volatility is rising, because this theta, look how big that theta is right now compared to the volatility. I'm only gaining 12 cents and I'm losing $2.45 every day. So even though we had that big jump in volatility, that did help. And it helped a little bit more than in my shorts because that short vertical spread, the put spread, again, I was selling an option and then buying a deeper out of the money option. That's a credit spread that gets hurt by an increase in volatility, but it's being helped by the theta. So the closer we get to expiration, watch what happens. I'll go back again to manage. And right now, just on these two positions, you can see that the vertical spread Newmont, the debit spread that I bought the calls is up $200. We're up $143 on the puts. If I go back, let's see, where did I do this one? Last week, is it this? Let me label the pictures quite right. Yep, it was this one. This is from the Thursday of last week. That was before the volatility jump. Friday is where we saw the volatility jump. If we go back to our chart, we were, and that's the entry. I think that's the third. Yeah, it is. So right there is where we ended up at the end of the day, just slightly above the average. And then, of course, the fourth, we had a big jump in volatility. So we can actually see what happened with price. At that time, the vertical spread, these are the puts, was worth about $135 in profit. Where is it now? 143. Okay, so we actually profited a little bit from Thursday until now, and we'll see why in a few moments. However, look what happened with the calls. They're only up 201 right now, right? Where were they on Thursday? They were at $461. And why was there such a big drop? Well, think about the time value. Volatility went up. That helped us. But what hurt us was two things. Price dropped. Again, going back to the chart, that's where we closed on Thursday. That's where we are now. So we lost $3, actually, yeah, a little over $3 in value, $3.15 roughly, maybe a little more. We'll call it $3.25 from the close to the close. So we lost $3 plus in value. And again, remember the delta, that tells us how much we're going to lose per day. And did it show the delta on that day? Sure did. The delta for the calls, 59. So basically, we lost $150 in value just from those 3 points dropping. But what also really hurt us was Thursday, Friday, Saturday, Sunday, Monday, time decay. because these options have a very high theta and the closer you get to expiration. You can see right now, where's our theta? There it is, almost $3. We lose $3 a day. Now 245 on the calls, $3 on the puts, which is actually a positive thing for the puts. So that's one of the reasons why when I buy options, I try to buy about 90 days out. You will pay more for the options, but in the long run, you'll actually save because you're protecting yourself. You see that when you go to an options chain, where here we have theta. Again, we'll compare at the money options, theta 10 cents, and theta over here, again, 10 cents. We have 9 days left till expiration. 3 days left for the 45s. Theta is 20 cents, doubles. But if you go out, now we don't have 90 days, we can do 73 days. And what is our theta there? 3 cents. So we cut it down to less. I mean, it's less than a third of what we had previously. So be careful. The theta jumps dramatically once you go within 30 days till expiration. You can see from 73 days to 31 days, we went from 3 cents to 5 cents, no big deal. But then from 31 days, 7 days later, where were we on theta? I said 5 cents. Now we're at 6 cents. It didn't jump too much, but it jumps quickly the closer you get to expiration. And it's not linear, it's exponentially faster. It jumped to 7 cents just about 7 days later than that. Again, you saw the big jump there to 10 cents. So make sure you buy enough time. And you just got to consider all the possibilities when you're putting together your trade opportunity. So if you're thinking, okay, I'm looking at this Newmont, and I think it's going to go up by looking at the chart, you do your analysis, and it did go up. Okay, I unfortunately didn't exit at the time because this probably would have been the highest profit day, whatever the day that is, 212, because we had a big jump in volatility. We also had a big jump in price. And people think, well, this is going to be nice where the prices continue to go up. We actually went from a close here about 46.79 to 48.15. We didn't go that much higher, right? Yeah, 46.80, we'll call it. 48.10, we'll call that. So it was 30 cents in price movement, okay? So 30 cents in price movement seems pretty nice because when you look at your delta, again, I'll look at these options that we're using right now, the 40 option, with the delta going up by 30 cents, 0.30, right, times the delta, 0.83, we would see a gain of, we'll call it 25 cents. Okay, now remember, that's per share, so it's $25 in premium gained on the price movement. However, that's going to be offset quite a bit because volatility at the same time dropped. Volatility was at 48.5, and on this day, it was at 41. We'll call it a half as well. So it dropped 7 points. Now I'm using the Delta and the Vega from right now, but they might have been a little different then as well. And you can see that, well, it's only showing 2 cents right now, but we had a much bigger move. So it dropped what about, well, it says only $14, but we also lost theta as well, which cut into those profits. So instead of gaining the $25, remember, we would have gained $25 from the price movement going up by that 30 cents or $25 total, but we lost 14 cents in volatility and we lost some time value as well. So it's not always worth it to try to hold on for that extra price movement if volatility is going to be going down and you're getting crunched by your time as well. We would lose 8 cents per day. How many days was that? 1, 2, 3, 4, 5 days. So 8 times 5 is another $4. So you only made an extra $7 holding on. And if you didn't get out in time, obviously, it dropped. Okay, so it may be beneficial if you see something like this where, okay, we went up a little bit more, but at the end of the day, what do you see? Volatility collapsed quite a bit. You might have to take what you got in hand at that point. And there are reasons to exit. Like I said, if you think that prices are getting ready to turn against you, either by physically moving against you, or if volatility is going to be moving against you when you're in a long or debit position, it may be beneficial to exit. And going all the way back to a statement that I didn't come to a conclusion on, we go into these trades because when you buy a call or buy a put, just a singular option, you are stuck with these Greeks. Instead of being stuck with whatever Greeks you have, we can use a vertical spread, and that's simply going vertically in price, not anywhere else on the dates. We're doing the same date, So we buy the 40, and at the same time, I can sell the 50. 9 days left to expiration. There it is. So I created that vertical spread now. And by creating that vertical spread, you can see delta, theta. It's not showing my vega right there right now, but it adjusts. I had a positive delta of 83. That dropped to 66. Why? Well, because I sold an option as well. So I gave up a little bit of profit potential on price, but what I also did was neutralize some of the theta exposure. Look at that. It was $8 per day, or 8 cents. Again, it's 100 shares that I was giving up every day as time passed. But by selling that option, look what I did. I reduced my theta to only 2 cents, or $2.46. So I reduced the time decay by creating that spread. I'm neutralizing some of the Greeks. That's the core reason why you do spreads. You do multi-leg option strategies, because you're neutralizing some of the Greeks and allowing yourself to be exposed to other Greeks only. If we don't want to be directionally exposed, we can do what is called delta neutral positions, where you take options that have offsetting deltas, a positive and a negative delta that are roughly the same value. Now you can do things like straddles or strangles and other things, iron condors. But for the most part, again, try to keep it relatively simple. And well, like I said, it didn't work out. It's working out. It's the wrong place. It is working out for the trade. It's just that I probably could have made a heck of a lot more, as you saw in the past. Let's see. I had the Thursday. Where's the Friday details? Here it is. Let me check what this picture is. I forget. Yeah, this is the difference between Thursday and Friday. Hey, did I get both of these the same day? Yeah, the exact same. So let me close that. And let's see if I can get them both to show. Because what I'm doing is I'm comparing Thursday and Friday. So Thursday, you see, we had that big price move. Friday, we dropped down in price, but went up in volatility. And this is what happened with those options. I can zoom that in more. There we go. All right. So the calls, they're kind of reverse. The calls are on the bottom here. You can see they're up $461. The calls here, they're only up $149. Why? Because price dropped dramatically. Even though volatility went up, the delta took you out. But look what happened to my short. The short put was only up $135. Now it's up $157. Why? Because we had a spike in volatility on Friday. And today, what's happened with volatility? It's gone a little bit flat. I don't know if it went down. It should have gone down a little bit, perhaps. And you can see now on the open position, it's still up 143, but 201, because we gained a little bit more delta back on the calls. So we didn't recover quite as much, even though prices recovered, not quite all that much. If we had closed up higher, it would have been really good. But you can see we only recovered a little bit of what we lost in that price drop. So that's why the short option is doing well. I mean, they're both doing well. They're both profitable, but it's not doing quite as well. So hopefully that makes sense. Again, volatility is very important. It's something that a lot of people ignore. So anytime we're looking at these options, I want to know, again, are options expensive or cheap? And you can even look at the theoretical value. It tells you right there. Theoretical value, 3 cents. What are we charging? 32 cents and 40 cents for something that's only worth 3 cents. So I definitely want to sell that for 32 cents. I'm basically selling it for what, 29 cents more than what it's worth? That's great. Does the IV indicator only work on daily time frames? I believe it does on the chart. Yeah, because when I was on a smaller time frame, it was saying it didn't register. Typically, it's working on the daily that you're looking at right there. Let's see. I replayed an option where I used all calls. Okay. It depends. I mean, all calls, I could do a vertical spread with all calls, or you could do condors or butterflies with those. The condors and butterflies, you're doing kind of a delta neutral with the vertical spread. Actually, there's also ratio spread. There's a lot of things with all calls. I don't remember exactly which one it was. Do you remember what the reason behind the trade was by chance? Oops, I'm going to go back time frame here. Daily. Yeah, if you go to TradeStation and under Learn, you got the Options Education Center. How do I think about the time frame to use for my implied volatility? Well, I look at the current implied volatility and where it is in the app compared to the average on the daily time frame. Because when I'm looking at options, I'm not usually day trading them. If I'm doing the day trade, which actually I do day trade some, but it's pretty much on the SPX only, the index options. Basically, what I was going to show here is if you go to the Options Education Center, which I'm currently at, you go to Learn on TradeStation.com and you go to this. But when you explore the strategies, ratio back spreads, you can do all call ratio back spreads. That is more of a directional play, but it's multi-directional. And you can do synthetic. Actually, that's not all calls. You have diagonal spreads. You have so many different kinds. Even with the calendar spread, you can do all calls as well, or condors and butterflies. Those would be all calls or all puts. So there's quite a few strategies there, but you can go through those and see which one it might be by watching the videos and just even looking at the strategies. So this, and you can see, let me go back one step. You can kind of see what the strategy would be used for by looking at the picture. This one with a synthetic, it's a directional strategy. So we have a long call, short put that makes profits if prices go up, but there is also the reverse of it as well. It's not pictured there, but imagine with these, you can also reverse them using the opposite option. Here we have a ratio back call, ratio back spread. There is also a put ratio back spread going the other way. This is a directional trade. This is a non-directional trade because you can go either direction. This is a non-directional trade. We want prices to stay pretty stable in a certain area. Non-directional, again, just looking at the risk profile, you can get an idea of what it is that you're getting out of this option strategy. Non-directional, those you're typically trading the time value and the volatility changes. Whereas if you have prices moving to make a profit in one direction or the other, that's a directional trade. And there's usually a bullish and a bearish strategy for those. So you have bull call spread, you have a bull put spread and a bear. There it is, bull put. And you have the bearish ones with it as well. Bear call, bear put. So getting back to, again, implied volatility timeframes, it was non-directional. It was probably calls then. It was probably like a diagonal, or not diagonal, a condor or a butterfly. So yeah, how do I think about the time frame to use for my implied volatility? Again, I typically look at the daily, and when it comes to intraday, I'm not too worried about the volatility though. I mean, yeah, again, when you take a look at these Greeks and how they affect pricing, let me go to smaller numbers here. Again, the delta is based on where prices are. The theta we saw increases quite a bit when you have very little time left. But the further you go out, the lower the time decay is. It's the opposite for volatility. The closer you are to expiration, look how little volatility is affecting you. So if I'm day trading options, I almost don't care about the volatility because the volatility change, even if it's a great change like we had from Thursday to Friday, it's not going to impact the price as much as some of the other Greeks might, especially theta and delta, right? The example was looking at what happened with the change in volatility from the third to the fourth, right? We had a huge jump in volatility in the pricing. I guess we had a pretty big price change too, because again, 461 down to 140, I'm sorry, 157. Is that right? Calls? No, it was calls right there, 149, $461 profit down to 149. That collapsed because of the delta, not because of the volatility change, because volatility went up. So we should have gained from the volatility, but because volatility is such a small portion now, the Vega is so small because these are expiring so quickly, only 9 days till expiration. Because volatility went up, it was not enough to compete with the loss from the price movement. And on the puts, we did have a small gain, okay? And that was not from the price movement because our delta was very, very small on the puts. As a matter of fact, where is it right now? Oops, keep going past. Too many things I'm working on here. Right here, if we take a look, this is not the open position. Let's take a look at that one. There it is, the open position and the puts. Oh, there it is. Yeah, look at the Vega. And it's negative 0.4. So it's nothing in comparison to the delta, 5.08. Actually, I'm sorry, it's bigger than what you see on the calls, right? The calls are almost not affected by the volatility change. They are hugely affected by the price change. Just zoom this in. That's the key thing right there. Again, delta, that directional change is affecting the calls. We lost what, 400 plus, like $300+ in value because of the price change. But even though volatility went up, it didn't impact this much. However, the puts didn't have as much of an impact from price movement. The delta there is very, very small because they're out of the money options. But the Vega was much bigger. That's why you saw a gain in that value. The time value was almost the same. That was not really much of an issue. But what happened, again, right here, we had Thursday on top, and I'll focus on the calls first. Right here, the calls were profitable by $461. Now those calls are only profitable by 150 bucks, basically. So we lost $300+ in value because of the delta, and the gain in volatility didn't help us. However, the puts actually gained some value, didn't they? They were only up 135. But because volatility jumped and the delta was so low, we actually had a gain in the position. Isn't that crazy? Both are bullish strategies, but the one bullish strategy gained more, again, because of the Greeks. That's it right there. You see it. There's the Greek. Oops, sorry, I can't draw today. The Vega and the Delta. So when I'm looking at the markets currently, almost everything you look at is probably going to have pretty high volatility at this point, right? We can go take a look at, say, SPY, just as a sample. And this is not recommendations or any kind of advice. Yeah, it's okay. You can definitely watch this over and over and over again. And it's helpful, obviously. But right here, the SPY has dropped. Whether or not it's going down, that's a decision you have to make. Okay, I'm not saying if it is going down or if it's going up. But theoretically, if we were expecting this to go back up, once again, we have those two strategies we could possibly employ. We could employ a bull call spread, buying an at or near the money option, call option, and then selling an out of the money option. Or we could sell a put and then buy a deeper out of the money put, the bull put spread. Well, number one, again, I'm not doing the analysis. So I'm not saying this is a trade I would take. However, step one, which direction is this moving? If we're bullish, we'd look for a bullish strategy. We think it's going up. So we go in our book and figure out, okay, we got this strategy, this strategy, this strategy. Step two, are options cheap or expensive? I bring up the implied volatility on the daily chart. That's usually what I'm looking here for it. And I can see we're way above average. So with implied volatility being that high, we are more than likely going to be bullish, but also looking for credit strategies, selling options. And we go to the option chain, SPY, go over to options. There's a chain. Get rid of all this. There we go. And let's collapse these columns for now. Way too many open. All right. Now we are looking at a credit strategy, right? Selling options, not buying them. So if we're selling options, we don't have to worry about the time value. It's more of a friend than a foe. We want the time to decay, and we have very high volatility. So we got to kind of balance this out and see what's the best to choose. Typically, I like to sell 30 days or less. You take a look at the deltas. That's not really much of an issue here, but the theta, again, we got 30 cents, 41 cents. So that's pretty good. The Vega, again, near the money option, about 60, both sides. If we compare that to one that expires further out, well, we don't have to go that far, I guess. We'll do almost 90 days. It's 83 days right there. And we got, let's say, 505 we'll compare. The 505 call, the time decay is only 21 cents versus 42 cents. I'm sorry, we're on the put side for selling. 31 cents. So if we sell the short-term put, we stand to gain 31 cents per day per share. But if we did the 505 quarterly June puts, we only make 14 cents a day. Doesn't sound as good. Yeah, we have more days, but that's more time to wait. And our rate of return is not going to be as good. Secondly, Vega, what's our volatility exposure here? Well, 505, the short term is 59. The longer term has more volatility exposure. So if we expect volatility to collapse, we would probably make more, obviously, on a volatility drop here than we would on the short term. So you got to kind of figure out, is it worth it though? Because you're cutting your time value in half. And this time value is going to increase dramatically the closer you get to expiration. So if we expect to stay in a high implied volatility environment for a while, maybe we definitely want to take the smaller, shorter time. Well, let's compare the two. If we were to sell 505 put versus selling the longer 505 put, go to analyze here. I'd have to do them separately, I guess. Can't analyze them together. I forgot because putting it together is a spread and I don't want that. So delete that position. Wish I could open multiple option station pros. It'd be kind of cool. But what we could do, okay, so here's the one put, and I got to change my default, still doing multiple contracts. So if I go to analyze just the single put, again, I would do this as a spread because I don't want to have just the naked put anyway. But if I do this as a spread, here we are, current price, okay? And if time decays, we get to keep that premium, right? But if volatility drops, see what the change is. Right now on SPY, the volatility is way up at 42. Let's just say we go back to the average. It's a 20-point drop in volatility. If price doesn't move anywhere, but we lose 20 points in volatility, we stand to make $1,288. Now, obviously, time is going to pass as well. So if we go to, let's say, 1 day left till expiration. Oh, no, we'll hold it to expiration. Never mind. Let's do it till expiration. Let's close out these extra slices I'm not using and keep it simple. There we are. At expiration, obviously, I keep 100% of the premium. But for whatever reason, if I need to exit early, if volatility does drop, even if prices don't go anywhere, I stand to make about $1,283 theoretically. Now, obviously, it's not exact. There's other factors. That's pretty cool. Let me go back to zero. Okay. And that was, what did I say, 1,200, 1,300 bucks? We'll call it 1,300, 1,285. Okay. Back to zero. Do the other option. Our options. This was the May 9th. So now we'll do the June. Same strike. Analyze. And then here we are. I'm at, yes, now. And then if we go to expiration, obviously we get to keep 100% of the premium. However, if volatility drops using the same price right now, we actually stand to make more. $9,900. The other value was only $1,200, right? Why? Because I did 5, not 1. There we go. That's better. I was going to say it shouldn't be that much different. It is a $1,900 profit, almost $2,000. And so we're looking at about $715 of additional profit by using that option because volatility collapsed. And that's selling. Obviously, time's going to go by too, so we have some more of that. But that's just on volatility changes. So by checking some of these things out, it gives us a better opportunity to figure out which one of those two options we're more likely to be profitable with, and we can look at our rate of return as well. I forgot what the cost was of the first one, because this one is $2,667. The other is, oh, not that much different, $2,063. So for the other 600 bucks, well, again, let's take a look at wrong place, analysis, and where's my calculator? Perfect. So this has a profit of roughly 1,900, it's showing 2005, but I'll just put it at 1,995, somewhere around there. Again, divided by 2692, 74% rate of return. It's pretty darn good. And when we're looking at, that's the June option. When we were looking at, which one was May 9th, you just change it here, it's easier. May 9th, it wasn't 2692 credit. It was, that's why I need to go back, 2063, 1285 divided by 2063. That's only a 62% rate of return. So by going further out, we have more volatility exposure. That's going to help us more than the time value potentially, right? So maybe we do want to buy a little more time and get some more time to more exposure. We could even balance it out, maybe split the difference. We got 30 days, 83 days. Maybe we look at this 52, and there we get less volatility exposure, but we have more time than we had before. So maybe that's a better balance, and we can analyze that one. So I go there, and actually this is the way to do it side by side. Well, no, not really. It's calculating both together. So again, get rid of this. Oh no, it was that right one. May 30th. There we go. And it's not the right price. So I gotta go back. Trade, analyze. 2342. There we go. And you can see it's a $2,300 profit. Basically, what, 100% almost? That's even better, isn't it? Theoretical value. Oh no, there it is. It adjusted 1617. I didn't think it was 100%. It just took a moment to readjust. So 1617 divided by 2342, 69% rate of return. So again, the other one was, I think, 74% on the high side. Going way out, it was 62%, something like that on the closer one, 30 days left. Here in the middle, we're pretty good, about 69% rate of return on our money because we're getting a good balance between time decay and volatility change. Now, granted, we may not even move back down to the average, but that's kind of what the average is there for. Typically, we have what's called reversion to the mean. When you move away from the average, you usually snap back to it. Move away, snap back. So that's a little bit more on the options and choosing what you might want to trade. Again, if you're looking for more of those strategies that are out there, we'll be back again with more of the options replay with you guys. And if you have any questions or suggestions of things you'd like us to cover, let us know. You can shoot an email to education@tradestation.com. Right? I think that's the email, Jesus. I've got to get going. I'm actually going to go referee some high school soccer. I'm an official referee for that. So I'm going to take off and have some fun with the kids. But yeah, let us know what you'd like us to cover in future sessions, and we'll definitely try to help you out with some of those things, whatever we can do.
For sure. Well, thank you. Thank you, Brandon, and good luck with the kids too.
Thank you.
Everyone, thank you for using your time to being here. Again, all these sessions are being recorded. I shared the link to the archives right there in the chat. If you look up a little bit higher, and if you cannot locate any content, please send us an email at education@tradestation.com. But again, thank you for your time. Have a wonderful afternoon, and I'll see everyone in our next session. Goodbye, everyone. Goodbye, Brandon. Bye-bye.